The Indian economy is going through a challenging time, and one budget speech by a finance minister cannot solve all the macro problems that have got created over a long period. We also have to see the budget speech in the backdrop of an election year, as this is the last full budget presented before the general elections in year 2014, in the backdrop of a tough global environment, in the backdrop of an economy which is decelerating on one side while showing overheating in the form of high inflation and high current account deficit on the other side. We would give high marks to the finance minister for walking a very good tightrope. The genesis of most of our macro problems, if we see, they all can be traced to excessive government consumption in last couple of years while neglecting the augmentation of supply side. Whether it's inflation, whether it's higher interest rates, whether it's decline of savings rate, our current account deficit, the lack of investors' interest, the collapse in private capex, these all have their genesis somewhere in the huge expenditure growth of the government in last 5 years, because we didn't build the supply side and we increased the consumption. We believe that the budget has made a credible move towards addressing these issues by taking the path of fiscal consolidation. The finance minister has tried to revive the investment cycle by announcing some measures like one-time investment allowance for large capex for corporates and some other measures. He is also cognizant of the fact that current account deficit is a big challenge, and foreign investors, whether in the form of FDI or FII or external commercial borrowings, have to be shown a red carpet to fill the gap which is created by the high current account deficit. And there are measures in the budget towards that target. Of course, there is a lot to be done, and we hope that over the next couple of months we will see more measures. The another big challenge that we face as a nation, particularly on the economy side and market side, is a decline in household savings, and within that diversion of that savings towards physical assets, and that has been a big cause of worry. And we are glad to see some measures towards boosting investments into capital markets. Again, I would though hesitate to add that they fall short of our expectations, and more needs to be done on that front, else we make ourselves very vulnerable to foreign investors, to the global risk appetite, and face an acute shortage of risk capital going forward. Again, we are optimistic that a lot many more measures would be taken by the ministry as well as the regulators, policymakers over the next several months to bring investors back into the capital market and divert the savings from physical assets to financial assets. Being an election year, the budget speech was used to please all sections of the society, rightly so. However, we believe that underlying message was clear, that reviving growth through encouraging fixed investment is critical. So fiscal consolidation, improving investor sentiments, boosting domestic savings, these are necessary ingredients to achieve that objective. Of course, the expectations were running high from the market's perspective, but given the backdrop that I earlier explained, the finance minister has done a reasonably good job. Now talking about the market, the big event is behind us. Of course, the markets reacted a bit negatively initially to the budget speech, and going forward, as I mentioned that the big event is behind us, we will have to watch global cues and incremental policy action, the pace of execution of whatever he has mentioned in the budget, and the incremental data points for further direction for the markets. Our belief is that the macro data points in terms of whether the inflation or the IIP, the GDP growth and some of the other numbers, similarly the corporate profitability are bottoming out. Maybe another quarter or so, and we are going to start to see better numbers ahead. We also expect the Reserve Bank of India to cut interest rates more going forward, given the fact that inflation has been coming down, the economy is slowing at a faster pace, and also that the finance minister has pursued the path of fiscal consolidation, which will give more confidence to the Reserve Bank to pursue a policy of accommodative monetary policy going forward. And that augur well for both the equity as well as the bond market. We have been reiterating that domestic investors have been underweight equities. We have seen a lot of flows from the global investors into our equity market over the last couple of years, while domestic investors have been net sellers. Given the long-term potential of Indian economy, of the Indian corporates, and also the potential of equity market to deliver inflation-beating returns over a long period, we would recommend investors not to stay underweight and keep investing into the equity market, and of course the systematic investment plan is the best way of putting money into the equity market. Similarly, there are opportunities emerging across the yield curve in the bond market, and we have funds which are positioned to take advantage of those opportunities, and investors should take advantage of that as well. Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.